Welcome back to Primary Source China Investment. This week we're on show F5, and we're talking about our roots, which is China investment. And the point this week is it's never been harder. The headline out of the Wall Street Journal this week is China's lost decade. And we've covered this plenty. Most Chinese stocks have given you poor performance and high volatility. In my almost 20 years of managing China assets and advising on them, it's never been more difficult. The current and perhaps future look grim. Deflation on the horizon, the property market's probably done for a generation, the population and the workforce are shrinking, even productivity is down. There are plenty of people trying to make the comparison that China is the new Japan, but more likely China is transitioning from a developing market to a developed market. And if you threw your hands up and said, you know what, China's uninvestable until there's more clarity, nobody would blame you. Even the eponymous Cathie Wood announced that her largest fund sold all of its China exposure. But most allocators can't just get out of China. It's not easy to execute. Look at VWO, the $74 billion EM ETF by Vanguard. China is its largest country allocation. There are a number of ways to unwind this. Perhaps the easiest is go sell your VWO and buy EMXC, which is EM without China. But if you're a global allocator, you probably still need to allocate to China. And we've talked about this a lot. Getting your exposure to China still requires more than a simple ETF. It requires a bit of active thought. So Peng Guo, from where we sit now, what's the strategy going forward?
The strategy going forward is still need some active management. So you still need to understand, especially for the sector-based. We talk about this a lot before. Another key thing is sector allocation, the rotation. So those kind of things is very important for the investment. Or you can have like the balanced strategy to do it. For example, right now it's in a global recession. It's very hard to find the growth sectors. But you have to choose like the high dividend index. So those kind of things would be popular in the downtrend market. And also from the economy perspective, China right now is in a hard situation. But compared to all the major economy entities, China is still much better than others.
Yeah, there's an old expression, you know, the economy is not the stock market or the bond market. And I think we're in a situation like that. You know, China's GDP growth, everybody used to marvel at double-digit GDP growth, but that didn't necessarily translate into stock market growth. Your point about dividends is great. And, you know, there's a few of my favorite names we've talked about in the past. You know, do you want to own China Merchants at a current PE of 5.9 and a dividend yield of 5.5? Well, that sounds like a very good place to park your money. Or ICBC at a 4.72 PE and a 6.6% dividend. Ping An, another one, has a PE of about 8.5, has a dividend yield of 5%. These are much better places to put your money than the fixed income market, right? If you look at the fixed income market, you've seen this long march to the lowest yields on the long bond in 20 years. You know, it's under 3% on the long bond. So if you're allocating, you have to weigh these risk and return profiles.
Yeah, that's right. And also control your expectation, because people always switch from the dividend and growth or appreciation. They just keep changing from this way to that way. They cannot resist the market get sold for 3 days.
Yeah, that's the folly of the retail investor, right? You know, when something goes up 3 days in a row, you switch out of your whole strategy, right?
That's exactly right.
Terrible. So one final thing I wanted to bring up is, you know, Beijing's been announcing a number of like generic supply side strategies to get consumers buying. But, you know, it's beginning to feel a little bit like that, you know, come on, do something meme. If the supply side strategies continue and the consumer is not feeling confident, no amount of stimulus is going to spark them. You know, I was looking at some gold and some consumer product, and The fastest growing consumer product in May and June was gold and silver jewelry. Gold ingot grew at the fastest rate since 2019. So consumers are looking to buy, but they're looking to buy assets that have a store value. And this is a pretty big sign in my estimation.
I didn't follow the consumer data, but it's a pretty natural way in the recession period, and the people buy some merchants will have the storage value like a gold or jewelry related stuff. So that's normal. So people means still have a purchasing power.
Yeah,
and need to release those kind of the energy into the right sections.
Yeah, it looks like they're going to restaurants and buying gold. Go to restaurants and buy gold. So the final thing I want to leave everybody with, and the U.S. market and the China market are not the same, but when the S&P bottomed in March of 2009, there was plenty of talk of a lost decade. So just be wary of following the trend. So with that, we're going to leave show F5. Thanks to all. Stay cool. It's hot in the summer.
Thank you.